Now, in today's market slot, we look at the economic week that was, and this in terms of oil prices, which fell to pre war levels. We also look at South Africa's consumer confidence that slumped in the second quarter of this year. Joining us this evening is Koketso Mano, senior economist at FNB. A very good evening to you, Koketso. Good to have you with us on Africa in Business.
Thank you for having me, Thami, as usual.
So let's start first with the economic week that was. We saw oil prices falling to pre-war levels. How significant is this? And is it something that's sustainable?
It is very significant because, we were hoping to come into this year with relatively low inflation, and obviously the war in the Middle East sort of um, caused the inflation outlook to deteriorate, right? So if oil prices are coming down, maybe even to the ranges that we saw before the war, this will be very positive for the inflation story going into the second half of the year. But now you ask an important question around sustainability. I think the past 2 weekends, speak to the fact that you will still see a lot of volatility coming out of the Middle East. There's a 60-day framework that needs to be concluded with regards to a deal. So there is a lot still hanging in the air. And Tani, we know that the parties involved in the war are quite far apart in terms of their expectations for this deal. So I think that will still keep some sort of geopolitical risk premium on oil prices. But it goes without saying that looking at the daily data from the Central Energy Fund, you can see that South Africa is looking to price cuts going into July. And, with oil prices remaining at current levels, you possibly see another cut going into August as well. So the developments are positive, but flare-ups will uphold that uncertainty.
So let's turn a bit of a turn to the consumer confidence, which slumped in the second quarter of this year as far as South Africa is concerned. How much of this has to do with this war in Iran?
A lot of it has to do with the war in Iran. If you think about your budget and how that has changed with higher fuel prices, how much are you still able to spend on discretionary items has all been affected by this war. And as I said earlier before, financial conditions could be something that weigh on economic prospects, but also household finances. So, when we look at the breakdown of the consumer confidence index, you will see that it's mainly your high-income households that have shown you a sharp drop in confidence. It relates to the fact that, we had an earlier impact on pump prices versus public transportation. We also had stock market issues following the war. So if you invested in the stock market, that would have been something that also affects your sentiment. So going forward, it could be something that also filters through to lower income households as public transportation has also responded to higher fuel prices. So unfortunately, at this stage, households are not as optimistic around the economic outlook, their personal finances, and they definitely don't view the current time as being appropriate to purchase durable goods. So here we're talking about houses, vehicles, household contents. All of these items and services stand to be affected by this deterioration in confidence.
You'll remember that there was yet another round of strikes and airstrikes exchanged with Iran. And now that has been, told to stand down, and another round of talks are set in Doha after this latest round of attacks halted once again. How are the markets reacting to this? And it seems to be a very schizophrenic tennis match at this point, moving from one point to another. It's quite dizzying. You don't quite know where to look.
Exactly. And I think, what we're seeing from the market is maybe the market is also getting tired of this schizophrenic movement and also this mixed messages coming out of the war. So I think the market is starting to be less responsive to these flare-ups. I think there's an expectation that you will continue to see these flare-ups coming out of the Middle East, so long as the deal is not fully finalized. And, whether the deal will be finalized within 60 days goes, it's a guess for everyone involved. So I think volatility will still be there. As I've mentioned earlier, there is still that geopolitical risk premium. But more important for us, from a macroeconomic perspective, we're worried about how is supply going to be affected over the long run, and how are logistics going to be affected, because all of that will have very serious implications for how low oil prices will go and how low we see oil prices going into 2027, 2028. Because if you do see physical disruptions from a supply point of view, that is something that can be protracted. And unfortunately, Thami, we have already seen shortages in Asia. So we worry that shortages will start to filter down as well. If you think about South Africa, not only from an energy point of view, that's not necessarily just a worry, but also fertilizer, food prices. So all of these concerns are going to be important so long as this war continues.
And as far as the stats are concerned this week, what are some of the things that you'll be looking out for?
A few things starting tomorrow. So we're looking at private sector credit extension. How is that looking? Because that data will start to show us some impact from the war, from the fact that, you're having these tighter financial conditions. Households, are they still willing to borrow from the private sector? Are they holding back? Are corporates still, looking to invest in machinery, fleets, and so forth? So that data is going to be very important. And we also will see from a trade balance point of view how that oil price impact is continuing to lift the import bill and weighing on the terms of trade also, and the trade balance. Then we will look at the quarterly employment statistics, which will give us an indication for the first quarter. So it's quite delayed, but I think if the household-based survey, the QLFS, is anything to go by, there's still a lot of issues in the labor market, right? Still showing you this weak growth environment. So it'll be interesting to see how the firm-based data will either back that up or maybe show us some tailwinds coming out of 2025. Lastly, Thami, we will also be looking at new vehicle sales data as well as the PMI on Wednesday, and those will be data for June. So we will start to see how, developments have progressed now that there's a memorandum of understanding. Is it already showing in the data, or are manufacturers still affected and are still negative around near-term prospects? And how has vehicle sales, as I've said earlier, with consumer confidence coming down, business sentiment has also come down. Is that going to start showing you that you could potentially see less investment in these durable goods going forward?
Koketso Mano, always a pleasure. Thank you so much for taking us through that market update for today.